Hello, everyone. Our next section here, hopefully, will be nearing the end. Let's see. And I will try to upload these documents here immediately after. We are going to go ahead and get through the second half of our project. Just give me a sec here. There we go. Clean, clean, clean. Okay, we're going to start through the second half of our project. And again, I will put an outline up there. I want to get right into this and get this out because if you are in the summer of 2025, uh, you're getting probably pretty used to having stuff crammed down your what feels like last minute. My sincerest apologies for that. I'm not doing that to torture you. I am just trying to pretty much change everything the way this was taught last year. Um, with artificial intelligence, it has changed so many things that it actually gives us an advantage where now I feel a little bit like having a crystal ball. I can ask you to do this, find this information, find this data online, and then you can start seeing how these tools are used. Okay. Uh, yeah. So then we can hopefully create a framework in your mind or an overlay. When you're looking at the world, you have your sort of business glasses on, kind of like a jet airplane pilot, or even regular pilots flying planes now have those overlays where they can try to line up exactly where they need to land and sight and dimensions and everything else in their little flip thing. So hopefully a little like that. That's what we're doing here. We're trying to give you the tools and give you the tools how you would use them, when you would use them in this process. And I very, very happy. I've had two students reach out and shared that they felt like they were starting to understand how you put all of this together, which is hopefully what a capstone is supposed to be. It's been talked about numerous times. The capstone in this program at the Ness School of Management and Economics and SDSU, we don't want you doing an academic paper. If you were in the econ program here, well, an academic paper, that might be a good thing, and there's been debate whether or not we should pull out those folks. But for the rest of you that are doing something business related, we want you to know how to use strategy, what it looks like, the tools that are used, when we use what tools, so on and so forth. Okay, so this is the second part to our main project, part two. Part two is going to get into the SWOT analysis, using it to kind of understand the current situation we're in. And the cool part about this is you can start pulling information that you gleaned when you did the part one or the situational analysis. That's perfectly fine. In fact, I would encourage it. Before we get into the second part to this, though, and the SWOT analysis and all the other things that we're going to add to it, um, I wanted to just remind you again of Rappaport's seven drivers. This is going to start mattering when we put together the seven drivers and the Ansoff matrix and how do we get the stock price to go up. And you might say, why is this all about stock price? Well, it's all about stock price because if you're running a publicly traded corporation, you're owned by stockholders who hire you as the CEO or an agent, the person that's running the company. They're hiring you to maximize this and uh, put the company in the best position humanly possible. So the question, if you're not, let me rephrase that. If you're not able to do that, guess what happens? Bing! Get rid of you and bring in the next person. And that is how it works and how it operates. Now, when we are, yeah, we'll touch on that in a second. Sorry about that. Okay, let's get back to it. I'm not the only one that lives in my house. Okay, so we're going to go through Rappaport's seven drivers, just like in part one. Anytime you see green font, please delete it and get rid of it. I've tried to put this diagram in a SWOT template also. Please take this, if it has a green outline around it, delete that before you submit it. And then anything that's in black, you go ahead and keep, like part two here. Okay, so just a reminder, now when we get into making recommendations, there's a logic thing. And for all of you, that's why you had to watch all these videos, because if you don't watch these videos and watch the previous videos talking about debt, inequity, capital structure, SWOTs, strategy, Porter's five forces, if you don't understand any of that, you're going to give very nonsensical ideas that to a layperson might sound good, but to somebody that understands this a little bit better, they'll read it and be like, are you dropping acid or what's going on here? Because that doesn't make any sense. Okay, so here again, you have to follow the logic. When we say follow logic, number one, you have to understand this whole idea about paying down debt. When you're a General Electric and you're a company that's worth $300 billion, dollars, you use debt as a tool. So we have to remember, okay, this isn't my own household where we're trying to pay off debt. Um, you have to understand Rappaport's drivers as we go through this, because you might have an idea, but that idea might be going in the wrong direction when you take into consideration Rappaport's drivers. Okay. Now, when we say logic and you give logical options of how to proceed forward, that doesn't mean safe. Um, and it definitely doesn't mean risk-free. We're going to see today how you add risk or how you account for it or adjust for it in this process. Um, Again, once you go through all of these sort of frameworks or frames of reference, what yesterday might have seemed like a good idea, or even one that's insane, and you're like, how could that possibly be a good idea? Once you put these filters on, you might say, oh, that's a little bit better of an idea than I thought it was going to be. Okay. So again, we have to use these. Um, we're going to go through all that. So here in the green, I'm just giving you an idea again of Rappaport's drivers. Now, in the world of management, we still say in this day and age that management is an art. What does that mean? It means if I go in and I were to run a company, the way I do it, I might find tons of success and I might do it just brilliantly. And you could have somebody else that does the exact same thing walk into a company, try to do the exact same thing, and it fails miserably. Okay. That's what we mean by art. It's just because one was able to do it and be successful doesn't mean somebody else would. There's something, kind of different about it. There's not certainty. Whereas if we talk about physics, well, physics, you have correlation coefficients that go out six digits. And that means almost every time something happens, here's the cause, here's the effect, and that's the reaction. So the difference between an art and a science. So when we look at Rappaport's seven drivers of value, we're not looking at them as science. We're looking at them as sort of an art or an idea of here's how you put this into play. So when we look at Rappaport's seven drivers, please remember Rappaport's seven drivers are like a real estate agent that's trying to flip a home. Okay. So if a real estate agent buys a $250,000 home, they decide to put $50,000 in renovations. They always do the bathroom and they always do the kitchen. They can put that $50,000 in renovations. That doesn't mean they're going to get $300,000 for the house, or they're going to get exactly 350,000 or 400,000. There's not an exact. It's more of a, well, typically when you do this, it's going to raise what's desired by particular customers. The same is true in publicly traded markets and running companies and things like that. It's, well, you might do everything right and it still didn't cause the stock price to go up for one reason or another. So another good example might be like sailing a huge shipping container. Just because you turn the I don't know, steering wheel or whatever it is, a quarter of a turn doesn't mean the ship every time is going to line up and be in one spot, because there's 50,000, 50 million other variables that are at work when you do that. So, and that's, we're not going to get into that's why you put in either a conservative sort of buffer or things like that. So just to remember, Rappaport's drivers, when we see sales growth, that typically helps drive the stock price upward, sales growth, profit margins, when those can expand, usually that will drive up the stock price. One thing to quick remember, just because, well, when you have profit margins that are getting bigger, usually you start having competition watching a lot closer because they want to find that. If you think about capitalism and business to some extent is like a gold digger, what do they call those? A miner, gold miner. And they hear about a place 2 miles west that they found chunks of gold that are the size of a quarter or something like that. Well, if you're not getting anything at this current mine, maybe you're going to go over, try to find some property in there to mine, to find those big chunks of gold. Okay. In business, when somebody finds a really good idea and profit margins are very high, so we're able to sell something a lot higher for what it costs to manufacture or make, well, then you have high profit margins. Other people are going to want to dive in and say, hey, I want some of that profit. Okay, so profit margins, think of that. That the increase in that's great. But if your profit margins are too high, then it begins to look like, oh boy, you get ready for the competition. Decreasing the income tax rate. So it's a corporation's job to pay as little in taxes as humanly possible. And we find out later on, well, no, we don't find out later on. That's often a mix of operations and tax deductions and strategically doing that. And hopefully the CFO is giving you a little guidance. Investment in working capital to me is like financial strategy and how to incorporate the right amount of short-term or long-term debt and maximize your position. Fixed capital investment, also called increase in CapEx or capital expenditure, means investing money in that new and improved project or idea. Decreasing your cost of capital, number six. We know that decreasing risk in the company, so making things more predictable, and utilizing debt more can bring down your cost of capital. Okay. And then lastly, extending the time period of competitive advantage as much as humanly possible. Okay. So we need to remember all that as we go forward. So in part two, the first thing I'm going to have you do is create a SWOT analysis. I'm not dumb. I know you're going to use artificial intelligence to do that. That's perfectly fine. But if you dare, you're going to want to read it online and then you're going to want to enter it into your own SWOT analysis and use your own vernacular, um, which I know can be challenging because I might call something a cost, but in the rest of the world, we might call it an expense. Okay. So sometimes that matters, sometimes it doesn't. Hopefully, after 4 years of studying, you can gather that what to put in and what not to use your own vernacular. Okay, so how you create this SWOT analysis, I don't care. In a perfect world, I'd sure love it to look something more like this on a handout, or if you want to try to put it down here. I've also added questions for each section. So, however you want to make that happen, this isn't rocket science. We're asking the questions like some of our strengths. Well, what does this company do really well? What do our customers say we do well? What's our unique selling proposition? Why do people buy? Is it because it cost? Is it value? What is it? And go through those questions and then give me a SWOT analysis. Now, typically, I'm going to stop this for a second because I think we use another diagram. When you do a SWOT analysis, there's one part that's internally focused and one part that's externally focused. That diagram doesn't do a good job, but I kind of liked how it had bullet points in each section. I don't think I've put in a SWOT in yet. Give me 1 second though. Click there, click here, and there we go. Okay, so typically in a SWOT analysis, you have your strengths and weaknesses that are usually internally focused. So you're looking inside the company. Then you have your opportunities and threats. Those are usually external in origin. Strengths and opportunities, sometimes we say are helpful, and then weaknesses and threats are usually harmful. Now, any smart strategist will tell you there are ways to look at a threat and try to harness it to make it a strength. Now, that doesn't mean that if we don't do something well, that we want to learn how to do it well because I don't even know how to say that correctly. You don't you don't want to try to change things that are never going to be. We say this in managing people, okay? If you have someone that has a weakness, you're never going to manage the weakness out of them. Okay. So if you have somebody that's very right brained and they're artistic and creative, if you try to make that person be left brain and detailed and bureaucratic and, detail oriented, it's never going to happen. So it's a waste of time to trying to remedy that or critique it. The same is true in a SWOT analysis. You don't, you can turn a threat into an opportunity, but make sure you're not spending an arm and a leg trying to make that happen or try to do that. Okay. And again, I don't care what template you use for the SWOT analysis. Fast forward in summer 2026 or future cohorts, I might give you an actual template to use, but for this first one in summer of 2025, go ahead and use whatever template you want to use. Preferably a quadrant template or just a written out answering those questions that are there. Um, the one thing you don't want to have happen when you are creating your SWOT analysis is you missed a blaringly obvious strength or blaringly obvious weakness in this. So it's again, I know you're going to use AI, but if you're like talking General Electric and you say one of their weaknesses is defect rates or something like that, I'm going to raise my hand and say, no, I don't think so, Tim. They're one of the leaders in Six Sigma. That doesn't happen there. Okay, so let's leave it at that. So you can answer these questions that are in each one of this template, or you can answer these questions. These are prompts to just help you to start thinking. Again, my guess is most of you are going to go on to Chat GPT and you're going to have, for target, create a SWOT analysis and you'll have it spit it out. Don't copy and paste it. Imagine that Chat GPT is like the Wall Street Journal or a 10K report or an annual report or prospectus from a company. So you have to look at the information, you want to cite it, go ahead and copy the link in Chat GPT. But I don't use your own words. Okay, let's just leave it at that. So here are questions to help prompt you into that, and you get all of them. Okay, next, part two. The next question we need to ask is, here's our strengths, weaknesses, opportunities, and threats. To me, the first logical question is, before we get on to figuring out how we should grow, we need to figure out if we should be growing. Okay. So here in question two, or whatever you want to call this, I have 5 questions that I want you to answer. So the question is, should we shrink? Should we stay static? Or should we grow the company? And these questions, again, are kind of like prompts to tell you if you answer yes to all these, then yeah, you should probably grow. If you're going through this and you're saying, nope, these are all no's, well, then maybe we need to start talking. Do we need to shrink the company? And that will get us to the next question. So the questions are, will this growth help the company become stronger and increase the overall revenue? I know for many of you are like, Bruce, how would I know that without looking at a full modified IRR capital budget? How would I know that? I get it. That's tough. But you could go onto Chat GPT and ask, is Target a financially strong company and expecting revenues to go up? And if Chat says, yeah, it looks like it, well, then there you go. You could put yes. So you're going to go through all 5 of these questions. Is the company in a solid financial position where growth won't create risks that could harm the company? Is there customer demand to support this, or is there evidence that the company can grow or should grow or customers do want something? Number 4, does this create a type of demand that isn't being met by competitors, other companies? And can the market support your idea? So you're kind of asking a similar question. That's why I lumped it together. So the answer would be yes, yes, or no, no, for the most part. Number 5, does this company have enough resources and are the employees ready for this type of idea if we're trying to grow? You have companies, especially those that are operationally excellent or cost focused, low cost producers, they don't want to grow because growth requires often innovation and change. And if you have huge changes, especially those that are unexpected, and you have a company that's an operationally excellent firm according to their value discipline, their employees, if they're not getting paid very well, so the company like Walmart, let's just say, I'm not going to critique Walmart here, but when they're hiring people, they are not going out there trying to find the cream of the crop and the best people that ever were. Now, obviously, there are some people that do decide to get a job at Walmart, and that's what they are. They're rock stars. But for the most part, Walmart is not, if you compare them, Costco, Target, Macy's, Dillard's, and you say, how much are the employees getting paid? Dillard's focuses on I would say customer intimacy or product leadership, one or the other. In that regard, they have to pay their people a little bit better because they need to recruit and retain the best people. Okay. So when we ask, are the employees ready for this type of idea? Yes or no? Now, here it gives you another prompt. If the answer that should be above is yes, then we should grow. Sorry about that, guys. If the answers are all no's for this, well, then we should probably stay static or even shrink. So then here, what's your overall recommendation based on these answers above? And that's what you're going to put down here. So if you're mostly yeses or mostly nos, okay, give me a sentence or two or three on the logic of growing. And I need to get some water. Okay, so then we get to the next question, and that's asking, should we be shrinking, consolidating, or divesting? Now, I'm sure a few of you have already, it's dawned on you, like, well, but Bruce, what if you have a really good idea that could, take the company to the next level or something like that? Wouldn't you want to try to grow that if it could help save the company? That depends, but the answer might be possible. Okay. So the next question we're asking, do we shrink, consolidate, or divest, which means sell off business lines? So first question, do we have underperforming DIPLAs? What are DIPLAs? Divisions, business lines, product lines, assets that produce revenue, usually that you would see in a capital budget. But think of it as business units or product lines. Do we have any underperforming DIPLAs, product lines, or businesses? If the answer is yes, put a yes in there. Do we have any DIPLAs that don't have a good fit with our current value discipline? Remember what the value disciplines are. If you don't remember them, scroll down here and there they are. We have product leadership, customer intimacy, and operational excellence. That's the dominant way in which the company competes. We also added operational excellence, which is kind of Starbucks, McDonald's to some level, would be examples of locational excellence because they operate everywhere and that's a part of their strategy. So again, do we have DIPLAs, business lines that don't have a good fit with our current value discipline? So there might be a business line that is a cheap or low cost item and you're a product leadership firm. Now, it might make sense to keep it because maybe that product is either a substitute for certain buyers or it might be a complement, an economic complement. You still might keep that, not divest it. Next, are we so strapped for cash or have financial distress that we need to sell off any business lines to prevent bankruptcy or serious distress in the future? Yes or no? Are there expected disruptors in the market that is going to make any of these business lines irrelevant soon? Okay. So if you were to look at, what are those called? Not smartphones, the flip phone and the ones where you had the QWERTY keyboard on it back in the day. Um, when iPhone came out with the touchscreen technology, that was kind of like a big disruptor to the others. The flip phone and even the QWERTY keyboard, we had Blackberries back then, which had a QWERTY keyboard on it that didn't work really well because the buttons were too small. So if having a touchscreen phone, smartphone with that type of technology was a massive disruptor, and it did put BlackBerry for the most part out of business. The only reason people bought from BlackBerry was for like military intelligence type stuff. So decimated them. Um, Number five, are there regulations or legal concerns, policies that are going to substantially impact any of our business lines? Number six, is the way in which competition is evolving in any of our business lines that they're going to force a divestiture? What does that mean? Is there a competitor out there that is destroying you in this one area and it's not going to be left after a year or two? And maybe there is another disruptor. So, any competitors you just can't even get close to competing with, yes or no? Number seven, will divesting any business lines increase the value of the company? Now, this goes back in our master strategy and tools document when we talked about the theoretical or the calculation we use to figure out whether or not a business line or a merger acquisition is worthwhile. And if you can just keep it in your mind very easily that if you have two companies, we'll say you have a parent company A that's very large. Let's say it's $1 billion company and it's looking at a competitor that's like a $50 million company. So you have $1 billion company and a $50 million other company. When you combine the two, okay, that the stock price needs to be higher than if they were separate. So if you add 50 million to 1 billion, you have 1 billion 50 million. So if the stock price is higher when those two are merged, okay, for one reason or another, if it's higher, well, then the merger acquisition was worthwhile. If it's lower and that does happen, well, then they were better off separate. You shouldn't have gone with the merger in the first place. So now the actual computing that and looking at that is a lot harder than what I just explained, but the idea is the same. And that's what you have to answer. Are we better off with this business unit, or would we be better off without them, and would they be better off without them? Because a lot of times when a company divests like that and you have people buy that, especially if you have like past employees that buy the company, a lot of times they can run the company far better because now they don't have 5,000 different things they're focusing on. They have five things that they're focusing on and they can get really good at doing it. Okay. So is it more valuable combined or divested? And will divesting the business lines, the DIPLAs, strategically align will divesting the business lines strategically align with the remaining company and its operations better? So is selling it off, maybe it doesn't mesh real well with other business lines. That's really what we're trying to ask there. And if the answer is no, it doesn't align with our value disciplines, then maybe divesting it. Okay. So here's our question. When you enter in the yes or no's, if the answers, sorry, you copied and pasted something wrong, above are yeses, then you should probably shrink or divest or get rid of those business lines or consolidate. If you've answered no in most of those, okay, well, then you shouldn't divest and you shouldn't shrink, okay, or try to shrink the company and sell off these business lines. And then after going through all that, because you're probably going to have some yeses and some nos, this isn't a perfect, if you have five that are yeses and three that are nos, well, then you better go with the yeses. It doesn't work like that. You're taking the whole thing together, and then what's your overall recommendation based on these answers above? All right. So that gets us into the next one. Made a video one time and I forgot to hit share. And it was like this. There were no students on it, and I didn't know until it was an hour into talking. Okay, so we are sharing. Next, question 3. Based on your fairly exhaustive SWOT analysis you completed in question 1, okay, we're going to start coming up with ideas on how to grow. When you do that, you're going to categorize those ideas in an ants-off matrix. Okay. Why? Because we need to categorize the level of risk that's associated with these ideas. Once you do that, once you have your business strategy, then you can format your financial strategy. So we're going to use a 9 grid ants-off matrix. You'll notice here quick, you see some red writing. That means on D2L, I have put a 9 grid ants-off matrix in a Word document that I want you to use. Okay. So I'm going to be jumping between this one and no, that's not the one I want. That is the one I want. There we go. No, that's not the one I want either. Need a Word document. How about that? Ants-off matrix for student handout. Okay, so you're gonna be filling out this sheet. Okay, not obviously we're doing this online, so you need to fill it out, via typing it in. So you're going to complete an ants-off matrix with all of your fun ideas that you're going to create based on your company's current situation, based on their SWOT analysis. Now's the time you start generating ideas. Okay. In the 9 box ants off matrix, I put a little frowny sign here because we've learned stay away from unrelated diversification. And I'm talking about if you're McDonald's, you don't want to start manufacturing Ford motor, tires. Okay. You know nothing about tires if you are trying to run McDonald's. So you stay away from any of those. So I've just dropped off the unrelated. Don't even go there. And you know not to go there because there's a funny little frowny face. Okay. So how we're going to do this. You have a couple different parts on this ants-off matrix, and I forgot to add this. You need to tell me your company's weighted average cost of capital, and then we're going to have you estimated base hurdle rate. Either way, you would have put it here. Okay. So on the sheet, make sure you put your name, put the company or ticker symbol or both, I guess. Give me your weighted average cost of capital, and then give me your estimated base hurdle rate. What is that? That is that rate that's slightly higher than the weighted average cost of capital. So I'm going to jump between screens here. So here in my example of an ants-off matrix and in putting in these hurdle rates, I had a company that was, let's say, General Electric. Their weighted average cost of capital down here was 8%. So I'm going to assume that it's probably not going to be 8%. It's going to be more like 9 or 10%. So I'm going to set my base hurdle rate, okay, at 10%. Put that in there. My weighted average cost of capital I put is 8%. Now, you have to give me that from part one of your assignment. What's the WACC, weighted average cost of capital? Based on that, you come up with a hurdle rate. Then what we're going to do is have a little fun with this, and we're going to start increasing that hurdle rate based on risk. Now, all of this is just an estimate, okay? You're kind of guessing in this regard. That's fine. And to some level, it would freak you out that in a lot of companies, that is how they do this. If they look at something that's very unrelated to what they're currently doing, maybe there's a little bit of connection there, they will say, okay, for this project, your hurdle rate's not going to be 10%. It's going to be 25% because we will be taking on so much risk in this that we don't know if we don't know what the outcome's going to be. So we're going to raise that hurdle rate given a certain level of risk. So in your ants-off matrix, when you're going to come up with these ideas, you got to try to do 4 to 5 for each one of these. If you only do one, nah, it's not going to work real well. So this is going to take you a little bit of time. Again, use any resource that's out there to help you out to come up with this. So we're going to start down here in the bottom left, okay, in our ants-off matrix. We have market penetration. or existing operations. Okay. That has the lowest level of risk. Screwed something up here. There we go. Okay, that has the lowest level of risk. Why? Because we're just operating how we currently are. So, an example of a market penetration uh, idea for General Electric might be offering like a sales discount. For this one, you're probably not going to have a ton. Maybe you increase radio advertisements or something like that. You're still selling to the same people, the same thing. Nothing's changed. So those are all examples of trying to grow the company with just existing stuff. When we do that, so your weighted average cost of capital is going to be whatever your weighted average cost of capital is going to be. And then you're going to put your base hurdle rate. So that just comes from above, okay? From right up here. The base hurdle rate is just an estimate that is slightly higher than what your weighted average cost of capital is going to be. And there's other ways to figure that out, but you don't need to worry about it for this class. Okay. So we've pumped that in. Next, you're going to start and go to the next, I would say go to the right or go up. So I'm going to go back to my regular Ansoff matrix. So in the market penetration, again, maybe like a sales discount. How about expanding a market? Well, what are ideas? How can you expand what you're currently selling? Now, some of you have picked like Target. Target only has really some retail operations and maybe some online sales type stuff. Uh, they're not in a ton of different business lines. If we talk about General Electric though, or 3M, you should have all the ideas on planet Earth because they are in so many they're conglomerates. They're in so many different things. The common denominator usually is they know how to manufacture. Okay. So here you're going to come up. The first one is a market expansion. And that means you're selling the same products to somebody new. Um, we used Gillette before. Maybe Gillette razors isn't sold in Papua New Guinea. So maybe that would be one idea that you're going to put for a market expansion. Maybe somewhere else. Now, then in your sheet, you're going to give me a risk adjusted hurdle rate. Okay. So if 10 is the base rate, then to expand the market is less known. So you're going to increase that hurdle rate by a little bit. Okay. So in here, if I'm doing Gillette and we're going to expand the market, now you notice you have more here. If I expanded the market to say Australia, you'd say why Australia? Why not? Is that right? I don't know. Close enough. If I'm trying to sell Gillette razors in Australia, okay, I'm expanding a market that uses the product that we're selling. Okay, they use razor blades over there, very standard. Or and Gillette kind of did this. They expanded their market by uh, selling to people that the same exact thing, but that they don't normally buy or quite buy. Now, market development and market expansion are a little different in that um, market development might be selling Gillette razors in, let's do China. Okay. Now, why would China be market development and Australia would be market expansion? What's the difference? Market development means they may not use the people there may not use razors the same way we do here in the United States. Maybe they're only have to shave like a little bit here, so their razors last a lot longer, let's just say. So market development is there, you have to develop the market. Market expansion is you're not doing a heck of a lot different than you are now, other than maybe you're trying to attract new people. So for here, market expansion, I'm going to put a hurdle rate of 11%. Why? Because it needs to be slightly more than what the base hurdle rate is. Why? Because you're starting to distance yourself away from what you know how to do best. If you're selling, you're doing just the expansion, though, you're not too far off. So I'm going to put 11%. Now here we put in China. For that one, I'm going to follow the one I wrote here. We're going to put 12%, or it could be maybe like 13%. These are just estimates. What I'm looking for when I review your guys's is to have similar numbers based on your weighted average cost of capital. And as you get farther and farther over here, that's when your level of risk goes up. Okay. So the hurdle rate's going to go up. Okay. Next, let's go over here. Product modification. Let's say we're Gillette. We're going to add a blade. Okay. Does much have to change to just add an additional blade onto something? No. Maybe another idea, I'll just put another one here if we're selling Gillette razors, is a handle grip addition. Something little piece of silicone that pops over the razor stick, and then that way you hold on to it tighter. Now I know some of you are like, really? You would pay a little more to get that stupid little thing? No, I wouldn't, but we're not talking about me. So we're going to put handle grip addition or add another blade. You're not making huge changes in this, okay? So our risk adjusted hurdle rate is going to be similar as expanding our market. It's going to be about the same. Now, there might be some really goofy reason why that you wouldn't do that. And maybe you could put that in a note there, or why this one might be higher than this one. Uh, if you do that, put some words down here telling me why you would do that, why this would be different than this. Okay. Then we're going to go here, limited diversification. Okay. You're going to put that in. Now, limited diversification is going to be higher than the market expansion. Okay. So we're going to start adjusting that higher though. In the limited, please tell me I limited. Yep. Limited diversification. Um, I apologize. I can't think of anything. But you are starting to get in that diversification realm. So you are going to add this. One second. More than just me lives here. Okay. So you would have limited diversification. You are starting to get into diversification though. And now we're going to increase the hurdle rate by a fair amount more. So we're going to go from a base hurdle rate of 10% limited diversification, we're going to put 15%. Again, you get to decide. You need to see a similar trend when you submit this. So as we get farther and farther away from your base, and you're because you know less and less at how you're doing something, then that hurdle rate, risk adjusted hurdle rate should expand. Okay. Same for partial diversification, come up with a couple ideas there. And we're going to put 17%. Because why? Because we're getting farther and farther away from that. So I'm going to put 17% here as a risk adjusted hurdle rate. And then I'm going to type in 3 or 4 or 5 ideas at how you could do partial diversification. Again, I'm not an idiot. I know you're going to go out and try to use tools for that to find that. Product development, we're going to put that at 12% as well. And partial diversification, we're going to put 17%. Again, there is no such thing as unrelated diversification. So, as we see, the farther you get away from the market penetration, the higher the risk adjusted hurdle rate gets. So here you're going to have all your ideas. Now, I forgot to say something. I didn't tell you how to obtain these ideas. Okay. One of the options you have is go acquire another company that already manufactures this. That's one option. Okay. Another option, let's say we're making razor blades. Maybe they go out and buy Harry's razors or something like that. Another option is try to do it totally internally. Okay. Hire new engineers that you don't know how to do this. So maybe you hire some of Harry's engineers in so they can help you to do whatever it is, your idea and trying to expand. So we haven't gotten to the part yet of where you're going to or how you're going to obtain that. Okay. So that also helps you when you're going through this. We're not thinking how, we're thinking what. What do we need to do, or what would be a way to expand our operations? Now, just because I'm a fun guy, I should be really teaching you about mushrooms. Sorry, I thought that was funny. In this top right quadrant, we have unrelated diversification. As I said, don't put anything in there. But if you were to, I went ahead and put 1 million%. So we would have to adjust, or the idea that is totally unrelated, we don't know how to do any of this, would the hurdle rate would have to be so high that to adjust for the risk, that the chance of actually being able to pull this off um, might not be an option. Okay, I'm going to actually hit pause there for a second because I'm going to bring up a calculator. If you've had other classes with me, maybe you've seen this before. And I'm going to use this real quick as an idea for you to understand what capital budgeting is. Once you understand what that is, I think quite quickly you'll understand what this hurdle rate is and how do we apply it. Just give me a minute. So I'm sharing this with you so you understand what capital budgeting is, or really the root of it is discounting cash flows. Okay. And in a business, what you would do is you would try to look at, you'd want to separate, well, what are your earnings? So you might have a balance, or excuse me, a profit and loss or income statement. And maybe you predict that you're going to have, I don't know, sell 50,000 units in the first year. So the next question is, well, what are our cost of goods sold? How much is that going to cost in order to produce the product to obtain that sales of 50,000 units? So you try to figure that out for 1 year on a prospectus or pro forma income statement, or excuse me, a capital budget of some sort. So you map out 1 year. Then you try to do it. You have your finance person come in and they try to figure that out on year two, three, four, five, six, seven, up to how many years. And then the question is, how much does it cost to buy all the equipment and to install this? And what's our first year's inventory cost? We call it an initial outlay. Okay. Now, the fundamental idea is actually pretty easy because you can do the same thing with your education. So in class, in the real world for a business division, this would be a spreadsheet that usually would have about 10 tabs in it, and it would be income statement feeding into next year's income statement to get your earnings to year three, year four, year five, and you would have estimates of earnings for every year. That's what you're trying to get here. So we can kind of do something similar with your education. So let's say you did the math and you figured out, oh, by the way, you don't have this calculator. Take personal finance with me and I'll get it to you. If you have this you figure out if you wouldn't go to college, how much do you think you could earn? So you go online, go to a salary calculator, go ask ChatGPT. And let's say you figure out that you can make starting salary, I don't know, $37,000 a year. Okay. The next question is, what are you going to school for? Then, in your first year's salary, what should you receive because you have this education if you get that job that you're trying to get? Now, typically, what students do is they make the mistake of thinking that they're going to earn the average salary. So you get a degree in business administration and you see the average salary out there is $65,000. Average is when you have the average amount of experience to do said job. So you don't start off making $65,000 a year. It doesn't work that way. So we use another calculator here to figure out, well, how would that equal a starting salary? So if the average salary was 65,000, the starting salary would probably be around 46 to $48,000 a year. Okay. We're just working with estimates here. Okay. Okay, let's go back to this. So we're going to say, okay, don't have a degree, can make $37,000 a year starting if I go get a job at 3M manufacturing tape. I'm going to go to school for engineering. When I go to school for engineering, I've had friends that told me I can make starting probably about $75,000 a year. Okay, because I have the education. Whoops, about 75,000. Okay, so then the question is, well, what's the difference between uh, having the degree versus not having the degree? And that calculates what we call your earnings. And that's what we're trying to deduce. So I'm going to use a different number here because that's screwing me up pretty bad. Let's say I went to school for business and I learned I could make $55,000 a year starting. Okay, I have a buddy that did that, for example. Okay, so because I have the education starting off making 55,000, I think I can get a similar job like my buddy got. I can earn the 55,000. So what's the difference between only having a high school degree versus now you have the college degree to get the job? So you have earnings or an additional earnings or incremental cash flows of $18,000 a year. You can earn $18,000 a year more than you could otherwise. So then what we do is we forecast that additional earnings um, by a number of different things. One of them is we do it by age because you have to factor in age. The other is we have to factor in inflation. Okay. Because that's not going to stay that way. It's going to inflate over time. So there's a bunch of different metrics we look at. The next question we ask is how much did we pay for the degree? So I'm going to say, and not like your housing and living expenses, but just the price of tuition, books, whatever's directly related to getting the degree. So I'm going to say it cost me $64,000 to get that degree, about 64. Stop adding the other zero. So what we're going to do is we use discounting cash flows, the present value and future value of these cash flows to figure out is it worthwhile to get this. So in this calculator, we're comparing $18,000, inflating, let's do 3%, why not? Increasing at a rate of 3% year over year over year. Put that in. Okay. So that's what these numbers are all running. And then we have to add that up and figure out, well, is it worthwhile to receive all of those earnings and pay for all of that? So the tuition, the price you pay, is it worth that to get those earnings in the future? Now at 18,000 additional dollars in a year, earnings of that, you can probably figure that out in your head and you're like, wait a minute, that's like 4 years and it's paid back already, the price you pay. And that's called payback period is a way you analyze that. So in the real world, we use two different calculations that are kind of like the same thing. I don't want to get too deep, but it's called net present value. So in a net present value calculator, what we're looking at is based on this price, based on those earnings forecasted out at this rate, is this uh, is that enough to make it worthwhile? So if the net present comes back and it's a positive number, then it's worth it. Now you have this other rate here that is, we call it the discount rate. Okay. In the real world of finance, you don't ever call it the present value rate. And if you can remember a present value chart that has all these different numbers, you have percentages at top and then you have years on the side or vice versa. And then you figure out the number of years times the interest rate. And then you go down in the chart and you figure out, oh, I multiply this by 0.75213 and whatever the principal amount is. And that's what the present value of that money is. We're doing basically the same thing. We're just extending it out times 50 years. Okay, so another way to do this is called IRR, which is what you guys are doing with this hurdle rate. You're trying to figure out, well, what is the rate of return on this project? So leaving the numbers exactly as they are here, okay, what we're going to try to do is increase this rate. We're going to try to figure out what's the rate of return on this investment. And then how we do that is we change this rate until the net present value gets to zero. Okay. So I'm going to try, let's do 12% as a rate of return. Nope, still positive. Let's try 24%. Now we're getting lower. So again, we're trying to get the net present value down to zero. Let's try 40%. Oh, too much. Let's try 35%. Nope, negative. 30%. Ah, there we go. Try 31%. There we go. So it's 30.4. Close enough. We got it close enough to zero when you're talking 50s and hundreds of thousands of dollars. So what we figured out, that's going to drive me nuts. There, that's better. So we have a rate of return on this education that would be equivalent to 30.48%. Okay. When companies do these capital budgets, this is what they're looking at. They're running a capital budget using the net present value, discounting cash flows, and then they're figuring out, so imagine this is a new product line. And here's what we're currently earning by adding all of this stuff on. Here's what we should earn in addition. And maybe we're only adding one version of a product line, so we don't have to make a lot of changes. So it actually doesn't cost a lot of money. Either way, we're trying to figure out how much will our revenue go up, how much will our expenses go up for the first year. And then you model that year over year over year times 5 years or 10 years or what have you. So then we figure out how much is it going to cost to do all this? Well, it's going to cost $64,000. Well, is it worth it to get those earnings in the future? So then you figure out and you set this net present value as close to zero as possible. And this tells you the rate of return on this project. Okay. Um, so if we have a hurdle rate that is 12%, is 30% higher than 12%? Yes, it is. Okay, then would it be worthwhile to invest in this product line? I would say so. 30.4 is a lot higher than 12. So hopefully that's making sense of this hurdle rate. Now, if you really want to get into looking at this college thing, the question you would ask is, well, how much does it cost if you want to borrow money to pay for this education? So we run that number and we say 6.8% is the average student loan rate right now. Then we go back, well, is it positive? If the student loan rate drops, then all of a sudden you're incentivized because it's going to drop the amount required to make sure you pay for that price. Okay, the price will drop because you have less going out in interest. Okay, now there's a bunch of problems with this calculation. One of them is we're not necessarily adding back the retained earnings. Um, in order to factor that in and anything that would be earned on those earnings, we utilize the modified internal rate of return. So IRR is I think about 65% of the time companies when they try to do this, they use IRR, internal rate of return. So this type of a calculation. But to take into account that retained earnings, they use MIRR, which is modified internal rate of return. So again, I think maybe about 20% of companies use this net present value thing. It's just a lot easier to have people do this hurdle rate. I think it's just people can logically think of it because most of the time in the consumer world, when you're trying to shop for a bank CD, you're looking at, well, what kind of rate of return can I get? So similar idea here. So again, that project or that idea has to be higher than the hurdle rate. When we did the hurdle rate, okay, we are modifying the hurdle rate to align with the level of risk of each one of these projects. As the hurdle rate or the risk increases, so too should the hurdle rate because we need to account for risk or the unknown. Okay, awesome. So you're going to come up in that handout. I want you to come up with examples of market development. Try to have three, four, five for your company, market expansion, market penetration. I don't care. You can have two or three on that one. Try to get four or five for all the rest of these, and you don't have to worry about the unrelated diversification because we're not going to do that. Okay, and then make sure you put the hurdle rates in there for it. So not too hard. Okay, So that gets us, you're going to create your own ants off matrix with all of those ideas. So I would imagine a number of you have ideas in your head already. Well, if your target, here's an idea that they could grow the company. Okay, great. Put that idea in the ants off matrix in the correct quadrant or the correct box. Okay. And the question is, well, how risky is it? Well, how much do you know how to do it currently? And the farther away from market penetration, the higher the hurdle rate because it's risk adjusted. Okay, so question number 4. Once you've gotten through all that, please list the ideas from the ants off matrix that coincide with the current value discipline. Okay, so what you're going to do is you're going to list. So if I use Target, um, no, let's use Gillette still. If I utilize Gillette for my analysis, Gillette competes on product. Okay. Yes, they have a cheap version of their razors you can get, but for the most part, when people are buying their razor, they're getting it because you get the closest shave. Um, so they have a product leadership value discipline. So the question is, when I look at all these ideas that I created, which one of those ideas coincides with product leadership? Okay. So maybe an idea for Gillette under product development would be adding that fourth or that fifth or sixth blade. Or one I saw they did here is adding in the regular straight razor a vibrating mechanism in there. So it shakes just a little bit as you're doing it because that's real safe when you're trying to shave. But it's supposed to then get in there better and get each hair, cut it a little closer. Okay. So would doing modifying the product like that does that coincide with product leadership? And I would say yes, you're adding a feature there that nobody else came up with. So I would put that down. Maybe and this comes, guys, back from your ants off matrix that you just wrote. So what you're doing is just copying and pasting ideas. You're just putting it in the right spot. So I leave this diagram in there just to remind you. So, and if your company is locational excellence, the fourth one, you can go ahead and put that down. So I'm going to write down all the ways. So let's say, and here you can use bullet points. Um, Adding a vibrating agitator. Okay. That coincides with product leadership. So we're trying to see, does your idea match with the value discipline? Okay. Some of them aren't. Okay. So now after that, you're going to write down all of these ideas you put in your ants off matrix and you're going to put them the ones that coincide with their value discipline. Next, you're going to do the same thing. Just tell me the ideas you have up here that don't coincide with the value discipline. Okay. So maybe one of the ideas was selling, it's a market expansion. Okay. That doesn't coincide with product leadership. Okay. That, and in fact, to get good at that or do that, they would probably start focusing on having a customer intimate because now they're going to have to change literally everything to market. The brand is going to have, or the logo is going to have to look different. A lot of things are going to change. So you're going to take all those ideas you came up with in your Ansoff matrix and you're going to list them out in down here. Those ideas that don't coincide with the value discipline. Okay. That's part 5. Now, number 6. Again, we're just doing a lot of copying and pasting. Using your ideas listed in the Ansoff matrix according to risk, label those down here, starting with the lowest risk. I apologize, I forgot to add here. No, never mind. Sorry. So you're going to take all of these that you just wrote, Or you're going to go back to your value or your Ansoff matrix, the paper you just did. Okay. And now we're going to take your ideas. We already sorted them by value discipline, those that coincide with the company's value discipline, those that don't. And now we're going to go and we're going to rank order them. So you're going to copy and paste them all into this table. So idea number one, we want to start with the lowest risk ideas. So maybe the lowest risk, we start off at a hurdle rate. RAHR stands for risk adjusted hurdle rate. Okay, so to have I'm going to do a buy one, get one free. Buy one, get BOGO. BOGO. Buy one, get one free is in the Ansoff matrix would be market penetration. You're not doing anything different. You're just trying to get people, the same people, to buy more of whatever it is you have. So there, my risk adjusted rate of return is going to be the 10%. Okay. Because the risk adjusted rate of return comes or is derived from the weighted average cost of capital. Okay. So we're going to put for buy one, get one free. That's down here in the Ansoff matrix under market penetration. For my company, it was going to be 10%. Now I'm going to put all the other ideas again, copy and paste from this, and you're going to put them in rank order down here from lowest risk or lowest hurdle rate all the way to the highest hurdle rate. So you're going to copy and paste again from your Ansoff matrix all of those ideas, but we're going to do it based on starting at lowest risk and working our way to highest risk ideas. Okay. So I didn't do the math. It would be like what, four? Oh, I got to sit here and think. So we have 9 different quadrants, 9 times 4, 9 times 5. Um, what gets you 36? So something like that. So you're going to put as many of these as you need in here, 30, 36, something like that. Rank order it by putting your hurdle rate. You put the idea, try to summarize the idea quickly. And then you need to answer this question. If this idea, so doing a buy one, get one free, if this should be done internally, how does it align with any core competency or sustainable competitive advantage? Now, again, that comes from over here. Okay. So it aligns by, well, we're not changing anything. Okay. Let's do the selling to China. Okay. So we would go back to our Ansoff matrix, my sheet. Better do this so I don't screw you up. Okay. Selling to China was considered market development because they don't probably currently sell there. So I'm going to put selling to China and that was up here. It's a hurdle rate, risk adjusted hurdle rate of 12%. Okay. I'll put the 12% in there. If this should be done internally, so selling in China, is that something that's done internally? This one's kind of screwy because, yeah, it could be. You just start selling it in retail stores in China, but it also might not be. You might have to hire a third-party firm to help do all this. Okay. So if we add in a third-party consulting firm, the question is, does selling this product in China align with Gillette's sustainable competitive advantage? And I would say yes, because you're still competing on product leadership. Okay. Or yes, because it's product intensive. Doing what we do best is not being exploited here. So yes, it would align. Now, here's the issue. If in your ideas that you came up with, and some of you are going to get this, you're going to come up with the idea of like trying to have a low cost alternative. Well, then if you have a low cost, if you're Gillette and you try to have a low cost alternative, guess what? It, we'll live in the land of make believe. They don't have a low cost alternative that they're competing with right now. Okay. So there you would put, does it align with this, the core competency or sustainable competitive advantage? If their product leadership and you're trying to sell a cheaper, lower priced version of it, no, it doesn't align because you're worried about producing the best product, not producing it at the lowest price. Okay, so hopefully that makes sense. All of this is trying to show you the alignment of these ideas in your strategy moving forward. Okay, and we're not done. So you're going to put all of those in there. You're going to rank order it from lowest risk to highest risk, just like that. You're going to ask the question, does this idea work with our current core competencies or sustainable competitive advantage? Okay, now question seven is a goofy one. Question 7 is asking, are there any ideas that you presented that would fit in a blue ocean strategy? A blue ocean strategy is one where you invent something and all of a sudden you've created a whole new market because maybe currently nobody has created this or they haven't figured it out. Maybe it's technology. So if that's the case, a blue ocean strategy, and you could put no for this one. If you're Walmart, well, maybe Walmart could have a blue ocean one. You create a completely new realm or market of people that last year were not buying this. Okay. It's usually highly innovative. So you create your own market. Apple, Google, they've done this to some extent with certain items that they have. So if your idea is creating that, most of you are going to probably put no here. Um, but if you can come up with any of these that are a blue ocean strategy that completely revolutionize how things are operating, then list those there. Okay. That 7 should be very easy. Then we have number 8. We're going to do a VRIN analysis. Now, I thought about doing the VRIO analysis, but I think I suppose it could be done with ChatGPT, but the VRIN, I think, just makes more sense for now. So that's what we use the VRIO and the VRIN to figure out, do we in fact have a sustainable competitive advantage? So here's what you're going to do. You're going to take your top 5 ideas. You can either pull these top 5 based on risk, or of all the ideas here, which one do you think is the best idea? Okay, that you think will work the best, it will unfold the best, that type of thing. Okay, so you're going to put those great ideas here, and then we're going to do a VRIN analysis. So I'm going to do selling in China because I don't have another one. Is doing that valuable? Is selling Gillette razors in China, is there value to that? And I think the answer is yeah, because what, there's like a billion people that live in China. So I would put yes. Is it rare? For the moment, and this has to be real. You can't make this up for this project. I can make it up because I'm teaching it. Is it rare? Okay. Are razor blades rare in China? Well, let's say it like this. Are surgically sharp razor blades um, a common thing in China? And we'll say, no, they're not. Nobody has this high end of a product. So if Gillette, this was their first time doing that in China, the Chinese market, there are no high-end razors like that, I might put yes. Now, here's the real question. Would it be hard to imitate in China? A high-end, super sharp razor? The answer might be yes, because there's times companies have core competencies and really trade secrets that other people can look at and say, I don't get it. I don't know how they're doing it. So maybe it is the sharpness of the razor blade. It's like, I don't know, the Germans are producing the wire filament that goes in there, and then Gillette just cuts it at an angle, and we can't figure out how to do it. So would it be hard to imitate? Might be yes, might be no. Now, because China is very good at stealing trade secrets, we're going to put no. It's not hard to imitate. They're pretty good at this. The next question is it non-substitutable? Is there an option, a different option for those buying in China than having high-end razors? Do they have another alternative? And we'll say no. Or is it non-substitutable? So is there a substitute? So the goal on a Vren or Vrio is you want them all to be yes. And I'm trying to, sometimes I get this screwed up. Is there another option out there? If there is not another option, so I need to reword this. If there is no other option, then you would put, yes, it's not substitutable. Think about it that way. There's no other substitute. So I would put yes here. If all of these are yes, then you have the beginnings of a sustainable competitive advantage. The only other one is our company structured around producing this? So let's say selling in China. Is it hard to imitate? We'll say yes, it is. Is it not substitutable? Is there another substitute that would be out there? And we'll say, is there, oh, this is a gal, I feel bad for you guys. It needs to be all yes. So what is that? Is it non-substitutable? We'll say yes. There aren't any substitutes. Okay, now I have a sustainable competitive advantage or a beginning. Technically, then you would have that. What we're trying to find as you go through these process, guys, we're trying to find that sustainable competitive advantage. Okay. What is it that you can do or Gillette can do that nobody has been able to figure this out? So if you have one of these, then that's usually the idea that you want to start with and what you want to pitch. Okay. So that gets us, and you may not have one, but that's okay. You can still go forward with the next part of this project. There's actually kind of a third part to this project. So this is all just a worksheet trying to help you frame out your thoughts and your ideas for this stuff for a strategy, and then we'll show you, okay, the third part or the last part of this is number 9. You're going to create a final report. You're going to open up a separate document. And I don't have a template for you to use. This one is all on you. You are going to write up a report of recommendations, strategy recommendations, okay, based on the ideas you've come up with here through this process that you're going to review or share with the board of directors of the company that you're doing your analysis on. Okay. So I'm just going to read this. So you're going to write up a report to the company's board of directors recommending those ideas, okay, and actions that you've generated going through this process. Okay. Now, remember as you're doing that, back to our risk line of thinking, when a board of directors is reviewing this, they want to know risk. How likely is it that you're going to be able to pull this off? So that's when you put in, we have a risk adjustable hurdle rate that we take into consideration the risk based on the Ansoff matrix that you created. So you're going to share with them, look, we did try to adjust this based on a level of risk. So you're going to put in the important information from all the work that you've done above up here and that you did in part 1. Now, this is going to get constrained, okay? How you're going to outline this is you're going to, first section, you're going to talk about the current situation. You are only going to have 1,500 words to put all of this in here. I know you're thinking, oh, geez, that's quite a bit. If you've done this right, you should be kind of frustrated because it's like, I'm supposed to fit this all in 1,500 words. Like that should be hard, more than anything. So you have the first part is your current situation. That's part one of what we just did. You're going to talk about those things in a fairly quick manner, share the highlights of what we should know. You did a financial review, you've done a vision statement, mission statement review, you've done all that. Okay. Next, after you've given the current situation, you're going to give a SWOT analysis. In the SWOT analysis, a part of the 1,500 words that you're going to put in this, okay, you're going to give the highlights. You're going to put the actual diagram that you create in an appendix at the back of this. Okay. So I would not recommend you put a SWOT diagram in the middle of this paper you're sharing. You're just trying to put the highlights of what's in there. Okay. So then you're going to have a small section that gives a recommendation for either should you grow, should you downsize or divest, should you try to stay about to the similar size you are now and not make any real big changes, which I wouldn't recommend because most board of directors know that you got to do something in a competitive landscape. If you don't act and you don't do something, somebody's going to come after you and it'll be game over. Okay. So you could stay the similar size, no real action, or you could stay a similar size, but you're doing so through growing some product lines and downsizing and divesting other product lines, or even wrapping them up where they just are no longer going to function. Your next section is to share your ideas and options for growth, to include organic growth or through merger and acquisition. When I say organic growth, what I'm talking about is you're going to do everything internally. Okay. So if I'm Gillette and I'm selling to China, maybe we hire a Chinese consultant and pay him in-house, but we're not going to work with a bunch of different parties to try to sell in China. We're going to do it all ourselves, which would probably be a bad idea. Another option, if you're Gillette, maybe go over to China and you're going to merge or acquire a current company that's making razor blades there. Okay. So you have two options to grow. Uh, for your ideas for growth is either do it organically or do it through merger acquisition. Okay. And then the last part here, you're going to make the recommendations of those strategies and use your rationale to get the board of directors to do what you think you should do. That's where logic comes in your rationale. When you do that, you're using the tools that we have gone through here to align. Okay. So you have Rappaport's 7 drivers. We're trying to decrease cost of capital. We're trying to do all those things. Simultaneously, we have to grow. Okay. You're going to create a SWOT analysis. So this type of a diagram goes in the appendix. In that SWOT section in your paper, you're going to write the highlights, like a paragraph of here are the most important things we found in our SWOT analysis. Okay. So those are the sections you have to have in this paper. Now, here's where this is a little different as well. You're going to submit parts 1 and 2, or you've already submitted part 2 on a separate sort of document. It's kind of like just doing a worksheet. This paper is, I want it to look like a real proposal you would really submit to a real board of directors for review. Okay. So you are going to try to make that thing look as nice as humanly possible. Now, as a little quick one, you can put pictures and diagrams, whatever. I'm still going to check, does it have the 1,500 words or maybe a little less? I've tried to do this before. 1,500 is about the absolute minimum I can get in there. If you want to do more than 2,000 words, and I promise you, I've already had 5 students contact me about, hey, Bruce, I feel like I could put way more in here. How much should I put in here? Um, the, that's a challenge to answer that one. So a lot of times I'll review that for the student to make sure, no, you've put way too much in, or no, you need to put more in here. Um, now let's just go through this. So In your analysis, in this paper that you're going to write, you'll have the 1,500 words. You might have a couple diagrams in that 1,500 words, the highlights, the most important things. Don't put the Ansoff matrix in there. Ansoff matrix will be in an appendix. The SWOT's going to be in an appendix. You can put the rank order relative to the hurdle rate and risk in the appendix. We don't want those types of things in the summary report that you're gonna hand in. Okay. Now, again, if you've taken a class with me before, you know I often grade on content only, not in this go around. In this go around, and I will probably should put this at the end. When I read papers like this, guys, it's a competition. I pull out the top five, six, seven papers of a class of 28 or 30 or whatever we are. I'll pull out the top five papers and I will set those aside and say, that looks like a paper. That looks like the best. Then, based on that being a 95 to 100% grade, then all the rest come in after that. So, if you have five students that just crush it, and I mean make it the nicest Word document, most clean professional document you've ever seen. Well, good luck for the rest of you because that's if that's an A, then yours might be a C or a D. Okay, it's gonna be competitive. Why? Because it's business. That's how we roll. Um, Okay, so you're going to get evaluated both on content and overall presentation. So how it looks. I haven't decided yet if I don't know that we're going to have enough time this summer. I would love to sit down and try to meet with each one of you individually so you can review this because I want to see if you really understand what you're talking about in regards to this stuff. But I think we're going to run out of time, and I really don't want you guys having to make a video doing this. Okay, so we're not just evaluating content, also overall presentation. The length of the summary section, this is the summary section, the outline of the paper. Okay, you should have hopefully no more than 1,500 words. I put here if you just cannot make it work and you have too many ideas here or important things you think, contact me. You can probably do 2,000 words or 2,500. I know with some of the students in here, I'm already going to get those types of questions. Can we put more? Maybe, but you need to talk to me if you're going to put more. If you try to put in 1,500 words and you're giving me garbly gook and stuff that doesn't make sense, it's like game over. Totally game over. Everything you submit in this project, part one, part two, and then the final paper, they have to coincide. If I can tell right away these don't make any sense, sorry, might see again here this spring. Um, Everything in part one, part two, you're going to copy and paste all of that stuff and try to put it in appendices. So when you submit the paper, it'll be all one document. The first few pages in the appendices, try to clean it up and make it look nice. Get rid of anything out there you don't find relevant to what you're trying to communicate. You'll have, I would guess, 2 to 4 pages with the outline, the summary stuff that we talked about. And then it'll be, I don't know, 10, 15, 20 pages of appendices. Um, References and resources. In my classes, I want you to use endnotes. Endnotes for this one, not footnotes. To find or to put in an endnote, you go up to reference, you click on insert endnote. Okay. You get that little Roman numeral up there. And then I want you to copy and paste. This will be at the very end of your full paper. That's why we're using endnotes. You're going to copy and paste the link that you got this from. Okay. I know many of you are going to have extraordinarily long links because if you're using Google or Chat GPT, they're going to be long. That's fine. The other thing you're going to do is you're going to try to shrink that font in that endnote down to like 5 or 6 font, 6 point font. Get it really small. Okay. So we can fit it on a short number of pages. Okay. So again, Now, for your SWOT analysis, I know for most of you, you're going to get a lot of that stuff from ChatGPT. When you do that, you just need one link, okay, or one citation. You don't need to have it for each bullet point in that. In the paper, no more than 1.15 spacing, so not even 1.5. I want it 1.15 because we want to fit this on as few pages as possible. Needs to look clean. I don't care about the font. You'll notice I like Garmin font, so you might get an extra, I don't know, 1% there if you use that. No more than 11 point font. Now, the big thing with the content, logic needs to be the driver of this. So that's why I put literally even in the instructions and everything in this second part, I put that in there because that's the logic you need to use when you're writing this recommendation. Okay. Now, a warning, because I know you're going to be using generative AI, ChatGPT, whatever, Copilot, or whatever those things are. Here's how this works. Again, get the information from AI, but use your own words and type it yourself. Okay. I'm going to read through this, and for everybody's paper, I am going to run through it. Uh, I'll just run through the written portion, the 2 page or 3 or 4 page, 1,500 word part into an AI checker. Whatever it comes back with. Okay. So I did this here 2 months ago. I had a student, pretty sure they were writing AI, and I got done and it said 68% of this project was written by artificial intelligence, or the like that much likely was written by artificial intelligence. So what I do now in my classes is whatever you would have gotten for a normal grade. So let's say that student's project, he would have got 86%, a B, 86 out of 100. So then I'm going to take that 86 and I'm going to multiply it by 32, which is the difference. 68% plus 32 gets you 100%, right? So I multiplied that 86 points by 32%, 0.32. So this student out of a 100-point assignment, because he used ChatGPT, got 27.5 points, so well under an F if that was possible. So virtually didn't get anything on it. So that's how I'm going to evaluate it with artificial intelligence. I don't have another way to do it, folks. That's why I strongly encourage you, don't have AI write this paper. It will not work. It will be bad for you. Last piece of this will be due on July 29th. Okay. Guys, I appreciate your patience as we've gone through this class this summer. I know that we have not gotten those assignments out, or I haven't gotten these assignments out to you as fast as I would have liked. I wanted to also make sure that you had those videos fast enough where you could do a project like this, because this is the good stuff. This is the stuff we want you to walk away understanding. So again, if you're in the summer 2025, this will be due on 7/29, which if I remember correctly, yeah, it'll be the semester or the section ends on August 1, so it's going to be about 2, 3 days before it ends. So it would, again will be due July 29th. I will try to get you out an email here shortly with the rest of the stuff you need to make sure you have complete for that. I think right now this is going to be the only project or big assignment type thing that I'm going to have you do. In 2024, we did have you write an ethics assignment. Um, if you're not in summer of 2025 and you're watching this video, double check. Don't listen to anything I'm saying right now about other work due. If you're in summer 2025, you'll look at your emails and see if I get that information out to you. If you have any questions, as always, make sure you contact me. If it is the summer of 2025, I encourage you to CC my BA Johnson at, or bajohnson03@yahoo.com email. That will guarantee I get it much quicker. My email does not seem to be updating very well on Outlook. All right, we will talk to you later.